you should know that experienced accountants don't like this stuff because what you've done is you've done a huge amount of calculations and you've added everything up and you've come up with a difference, and that's the golden number. And accountants don't really like that because if there's one mistake, one little mistake anywhere in these calculations up here, if you got one exchange rate wrong, then the whole thing is wrong and your gain or loss was calculated wrong. So we have a proof of adjustment here. And the purpose of this proof of adjustment is to check your work to see if there might have been a mistake. So basically what you would do is you would take the net assets at the beginning of the year, which happen to have a euro value of 40 plus 10. And then you add in the net income, which should increase the amount of net assets. Net income of this sub was sales of $50,000 minus cost of goods sold, operating expenses, and foreign currency translation. So it'd be 12,500 euros. You subtract your dividends of 62.50, and you should get your net assets in euro at the end of the year, 56,250, which should be equal to, you don't have the close there yet, so you can't really see it. You know, because this is not a closed balance sheet. This is beginning of the year retained earnings, so 50,000 is less. Anyway, this here, last year, all assets and liabilities converted at the historic rate of $1.20, which would give you dollar values of $60,000. Net income would translate at the average rate. In this case, the average rate is $1.30 for that year. Dividends paid would translate at the rate of the date of the dividend, $1.36. Or 8,500 subtraction. So this would give you net assets in dollars of 67,750. I'm sorry, I should put this here. 67,750. The actual net assets in dollars turned out to be, let's see, all of these assets minus these liabilities turned out to be 78,750. So you would wind up with an OCI adjustment of $11,000. It would be a gain because you have 11,000 more assets than you expected, i.e. the credit, and that's how you would check your work here to see, well, wait, there's one more thing you got to do, and that would be that's how you would check your work here. And you would see that it's $11,000. Now, there's nothing in accumulated OCI at the beginning of the year, so therefore, by the end of the year, you should have accumulated OCI of $11,000. Pure listed journal entries during the year. One journal entry would be to receive this dividend. The dividend was for 6,250 euro, exchanging at $1.36 or 8,500. So you would debit cash for 8,500, credit investment in German company stock because that's the journal entry when you receive dividends under the equity method. Then we have the income of the sub. And we're just going to calculate the direct translation of the income here, which would be the income of the sub times the exchange rate. In this case, it would be debit investment in German company sub. And the total value of the income would be, it was $12.50. What you could do is just add up here, or you could take it from the calculation we did before. 65,000 minus 29,250 minus 18,850 minus 650 equals 16,250. And credit income from subsidiary or investment in subsidiary, 16,250. And then the last thing you have to do is record the accumulated OCI. In this case, accumulated OCI is a credit because they had a gain. So this is going to increase other comprehensive income. It's a translation adjustment of $11,000. And the debit would also go to investment in German company because this also increases the book value of the investment. Now, there is this matter of the patent amortization. This is where I can usually keep most students involved until this, but this is not hard at all. The patent has a $3,000 value, but the patent doesn't really belong to the parent. It belongs to the sub. Therefore, the functional currency of the patent is not the dollar, and it's not fair to write this in dollars. It's really the euro. So the patent is worth whatever it is in euros, not what it's worth in dollars, like I wrote here. So what we have to do is we have to figure out the new value of the patent. Originally, the patent was booked at a $3,000 value, and the exchange rate at the time was $1.20. So in euros, it had a value of 3,000 divided by $1.20, or $2,500. And this patent needs to be amortized over 5 years. So annual amortization would be $500. That amortization would translate at the average rate, which is $1.30. So it would be 500 times $1.30, or $6.50. So you would have a remaining book value of the patent of 2,000 euros. In dollars, that unfortunately happens to be $23.50. Don't get stressed out. Don't worry. So this patent on the balance sheet is going to be on the balance sheet for 2,000 euros. That translates at year end at $1.40. So therefore, it should have a value on the balance sheet of $2,800. So what's happened is that the value of the patent has also increased along with the other various assets. And you're going to have a gain on the patent also of $450. So these don't go on the books of the sub, but the parent is going to take credit for them. The parent needs to record the additional amortization of the patent. That's going to be debit income from subsidiary, just like we did before. Except in this case, it's going to be $650. Because that's the dollar value of the 500 euro amortization. And the credit would be to investment in German company stock of $650. Then we also need to adjust the book value, the balance sheet value, according to the new exchange rate of 2,800. Because this would only get us to 23.50. And it should be 2,800 because this is worth 2,000 euros. The rate is $1.40, so it should be on the books for 2,800. So we need to write up this investment by additional $450. So I'm going to debit $450, and like this translation adjustment up here, this is going to be the same kind of thing, and this is going to go to other comprehensive income. Translation adjustment for $450. So this piece of it here is the most difficult thing we're going to see all chapter, and you want to look at it. I say that not to scare you, but to suggest that you look at it very carefully, because this is where a lot of people mess up. And then finally, let's just look at, this is a new edition. Actually, this wasn't in the older edition of the book, I don't think. But it's a good thing to know, is what your closing entries would look like. You would have all your normal closing entries that the parent records. But in addition to that, the parent recorded some income here that I've got to reverse. So I'm going to debit income from subsidiary. In this case for, let's see, what do they got here? 16,250 minus the 650 recorded over here. So that'd be 15,600. That's the reverse income from subsidiary. If you're like, why would you debit income from subsidiary and closing entries? Then you got to go back to your intermediate accounting book and look up closing entries and go back over that, because it's extremely important. That's something you don't want to forget. If you're going to forget something that's not very important. But don't forget closing entries, because closing entries is extremely important. Then let's close other comprehensive income translation adjustment. And you're like, where? That's the items that go to the shoebox. And we had two items going into the shoebox here. The first went here, and the second went right here. So that's 11,000 plus 450, or 11,450. And the credit, they actually go into the shoebox. The shoebox is accumulated OCI translation adjustment. That is that item on the balance sheet where things stay until they finally hit income. The next learning objective, I'll show you how to do the consolidation.